I get it. It is tempting to lock in profits right now, but my portfolio has never been higher. And I'm not selling a single share. Here's why. Most people sell when the market's at all-time high and things look good. That is exactly why they don't make very much progress and they stay broke. The reason is, and I made a different video on this, why I never sell shares is because 3 out of 4 years the market's going up. Why would you want to give up 25% of your opportunity by selling? You don't know when it's gonna, I guess 75% of your opportunity by selling at the wrong time, right? You don't know when it's gonna go down, right? I don't know. Nobody knows except for the people who inside trade at the top, right? So that's why I don't sell. And that is to show you the power of that. Let's look through this. Today is 10/28/25. It is the day before the Fed meets. We just had a very green day. I'm up 1%. Who cares, right? It's like 1%. But 1 week, I'm up 24K. 1 month, I'm up 39K. 3 months, I'm up 67K. Year to date, I am up $143,000. Yes, I know I only have a $600,000 portfolio, but this is to show the power of total returns. I did this pretty quickly. I did this since 2022. I say this not to brag, but to show you the power of total returns. So many people care so much about dividends, and I want to show you why this is so powerful. I want to teach you the better way, the way that I do things. If it doesn't work for you, no problem. Some people like to do a hybrid strategy, some like just income only. I think that you should maybe take a look at YouTubers with a comparable size portfolio and see how long it took them to get there. Was it in just a few years like this? Like, what did their year to date look like? Are they up 34% year to date? Are they up 10%? What does that look like? And you need to start to take a deeper look at things just so you can get an understanding of this. So I see there's someone in my comments who keeps talking about, let me show you here something kind of funny, that he keeps talking about how he's using margin at the top and then he thinks that he has more ability to buy on the way down. That, my friend, is how you get margin called. So don't do that. The reason is that when it goes down, like if you don't have any leverage yet and you haven't used any, that's perfect. Yes, you have less buying power when you go down because your total value went down, but you are so much more protected and then you have the ability to deploy so much more margin. If you lever up on the way up and then it goes down, all of your ability to use leverage is gone and you are way overexposed. If there's a 2008, you will be wiped out. So you need to be very, very careful. You need to have a system to follow. I am sticking to that system that I have. It's outlined in my ebook and I've gone over it quite a few times. But to give you a brief summary is while the market's going up, I'm paying off debt. When the market goes down, I am levering up with margin. And to give you a quick idea of what that looked like, let's go take a look at activity of the 2025 bear market. Let's take a look and see when some of my last buys were. So if I were to go here, I bought on April 21st for $3,000. I bought on April 7th for $7,500. So let's go back to April 7th. Let's go to 1 year so I can see a little better. April 7th. I'm like right around the very bottom here, right? Like there's one day where it's lower. It's April 8th. So I almost bought the bottom, and it's not that I was trying to time it necessarily, but if I wake up and the market's down, lever up, right? And it's, let's go back a little bit here so you can get a better feel too. Can I see more on my screen? Yes. So if I go next here, next. So in January, instead of buying shares, like there's a couple months where I was paying off debt. And for a while, like the market's going up, up, up. So I'm mostly focusing on paying debt. And then as we got to March, you can see I started to, and I'll show you another screen here in a minute, but you can see I started to make bigger purchases to buy more because the price of shares was becoming more lucrative. It was making more sense to use margin. So March 11th, I made a buy for 3,000. As we got deeper and the price kept going down, I would buy bigger buys. March 28th was a pretty big buy for me. So it's like I'm not at the bottom, but look how much it has already come down. It went from 643 down to 543. So that is, I pulled up a calculator that you can't see, but that's about a 16-ish% decrease. So my friend Margin Mindset just talked about this margin of safety. What that means is imagine you're at an all-time high. You have so much room to fall in share price. You can fall all the way down. Like if it's an individual stock, you could fall 100%, right? If it's an ETF, you might fall 50, 60, 70% during like a dot-com crash. But that, first of all, that takes maybe a couple of years before you fall 70%. You can fall 30% pretty fast though, so you got to be careful. But margin of safety would be once you've already fallen 20%, it becomes pretty unlikely that you're going to continue to fall another 30%. Odds of that happening are so much less. So it becomes safer to deploy leverage as the price has already come down a lot. That is another portion of understanding how to use margin safely. You need rules, you need a system, you need to be safe, right? So right now I'm working on getting this up. I'm going to probably get to like 75, 80%. The other day, yesterday actually, I was looking at the dot-com crash just to see if something like that would have margin called me, and it would have. I do have safeguards in place, but I have built a pretty nice little nest egg here that I want to protect. As you get bigger, it becomes more important to protect what you have than to grow it. When you're starting, you don't need to worry about protecting what you have because one, it's easier to protect because it's easy to pay back a couple $1,000s versus paying back hundreds of thousands of dollars. Two, you don't really have anything to protect. What do you have to lose? Like, take some risk. But B, like, keep in mind, I'm not a financial advisor. This is not financial advice or legal advice. This is my own experience. Don't take stupid risks. Don't be just day trading. Don't be trying to buy the next Bitcoin, right? Don't try like XRP to the moon, right? Don't be doing stuff like that. If you want to grow wealth, it's consistency, it's never losing money, it's understanding leverage and only buying things that are safe with leverage, right? People buy real estate with leverage. So if you've ever bought a primary home, you've already used leverage. So you need to be safe. You need to have a system. I outline my system in my ebook, Money Isn't Real. It doesn't mean that's the system you need to follow, but if you want to see how I do things, that's how. I've done, I think, a pretty thorough job of giving a nice overview of how I manage my money and how I've grown so quickly. But everyone does things differently, right? So maybe you like a hybrid approach. I know a lot of people in my comments keep talking about how they like hybrid approaches, and the reason is they like some income. So if I personally wanted income, and I do have real estate, I have some rental properties, and they're nice, but I'm gonna de-lever my real estate to put them into stocks. But if I wanted income, I would just buy real estate. I wouldn't be buying a bunch of dividend stocks. Total return matters way more than income. And if you want income, I would rather have real estate at good interest rates, which they're not that great right now, by the way. But my real estate, I have a 3.75% interest and I have a 2.5% interest rental property that I bought in 2020. And those would be great for cash flow. But what I find is that the repairs, the maintenance, the turnover, the periodic vacancy, it's just not worth it. I would rather go spend my time making more money and not having to worry about those things, right? So, yes, the appreciation from real estate can be nice depending where you live, right? Some places are better than others. Big cities are often very good, but I think it's a great way to build wealth by owning a primary and renting out one or more rooms. I do think that in general stocks are better than real estate. That's my opinion, and my industry is real estate. Real estate. I think it's great to own your own home. I think that if you're able, it's always great to do. So, real quick, I have talked about this a few times. My margin debt. It's about to go down. Fed meeting is probably the day that I'm going to post this video on March or October 29th. And then my payment will go down. So my cash flow goes up naturally when that happens. This is a variable rate. My interest rate is variable and it could go up, and it did go up. It tripled in 2022. So that destroys your cash flow. Cash flow is very important, and I did just talk about it in one of my recent videos. Cash flow is very important. You can't use this strategy if you don't have cash flow. So this I can give you an idea quick of what it has looked like throughout the year here. So in my spreadsheets here, I have an M1 finance tab, and you can see I need to populate October in a minute here, but I went from 405K up to 447K in M1 finance net worth that month, this month. So that's going to feel fantastic. It's going to change a little in the next few days here, but this went up and I didn't buy any shares up to, I'm at 594 today. So that feels fantastic. So total return matters a lot. This went down to 147 and this is unclear, but it's right around that same price. It's about to go down for the month of November. First of all, there is 1 day less than in October. And second of all, the Fed is going to cut rates by 0.25 basis points. Likely another cut coming in December. Probably some future cuts coming up too, making this even more powerful. It naturally opens up my cash flow. So many people ask me how I pay my dividends, and about a third of it comes from my people ask me how I pay my margin debt. So about a third of it comes from my dividends, and I show my dividends here on this column, and you can see that when I levered up max leverage in April, May, my payment got pretty big, right? That's for me, it was a pretty big payment. It was at 6.25%. There were times I saw 7.25%. And my payment was a lot smaller because I had a lot less leverage at that time. So throughout this strategy, when I started out, my leverage was much lower. I had a much lower leverage. This is a quick way to get into like a $500,000 portfolio in a few years. You have to be careful. You could get margin called. You could lose everything. That's why you should have a system. If you don't want to follow my system, no problem. Don't buy my ebook. Feel free to learn the tips you can from me for free. I give a lot of them, but build your own system, do your own research, figure out how you can stay safe. My system has done me very well, and I am going to continue to follow it. And I don't like to sell shares. I don't plan to sell shares. I plan to deleverage my real estate to put it into stocks so I can quickly get to 3, 5 million. And I am excited to share that journey here. So I am looking forward to showing you how powerful this is. And I hope some of you will join me in this mission. And I want you to be careful though. So don't be reckless. Okay. I'm not a financial advisor and you just, you need to do some research, but this is a very powerful strategy. So there's a ton of opportunity here and I'm looking forward to growing with all of you. So make sure if you got some value from this, you like, share, and subscribe. See you next time.